What I was doing was trying to zoom out. I try and spend as much time as possible hearing the noise and then trying to step back out of it to say, okay, if you filter out the noise, what is going on here? And it was the deleveraging of the space, but my liquidity indicators, which I think is the primary driver of, well, all markets, were bottoming. So I'm like, so here we are, just take the log trend of Bitcoin or the log trend of ETH. We'd come down to the log trend, which is the secular uptrend, and we're at the bottom of the liquidity cycle, which was turning up. So that to me was like a golden opportunity. And I started making noise about that, saying, well, that June period was really an opportunity to start, significantly adding into the space. I'd not sold anything. And that if you understood the liquidity cycle and the business cycle, which most people in crypto didn't really yet understand, that this was going to be a good opportunity. But if you truly believe in a longer term time horizon, then these are the opportunities you wait for. I've been very optimistic over this whole period because the narrative was peak pessimistic. And there was only one hypothesis to test. Is this technology going away or not? That was the only hypothesis you had to have. And if you didn't see evidence of it going away, or use cases dying, and the other thing that backed up my theories were we saw, $60 billion of VC money go in? So there's an incredible amount of startups building new projects, building new areas, which will form the next foundation for the bull market. Now, we've never seen that much money in the space before. I mean, it's like 10x the size of the entire hedge fund market in crypto. Just went in like basically 2 years. So you have to start betting on the outcomes of that. What does it mean? What are the opportunities that are going to come that we don't realize? We know there's infrastructure stuff. I know you guys are involved in kind of the ZK side and all sorts of stuff there. We're also seeing some new layer ones. Do they help or not help? Who knows? But we're also seeing, I think, people working on how to get mass adoption. What is the consumerization? It's one of the things that also attracted me to the Solana ecosystem as well, which is really a small part. Mainly my main bets are in ETH, but because if I were to say Solana stands for one thing, it's a consumer application chain. Now, narrative is everything in this game, particularly in crypto. The meme wins. And if that's their meme, that's a nice meme to have because nobody else owns that. Somebody's going to own blockchain of gaming. Somebody's going to own blockchain of finance in the end, because I think that's how the space evolves. So yeah, with all of those macro factors, with peak macro pessimism as well, I started getting long the equity market for the same reason. It's like the pessimism was obscene. People attacking everybody who could be vaguely bullish made me think, okay, if the liquidity cycle is turned, we know what happens, which is over this period, the economy will weaken. So the probability of more liquidity, or more cowbell, as I put it, comes back into the market. And therefore, forward-looking asset prices, technology, crypto, will outperform. And that's been exactly how it's played out. Never feels that way because there's so much bloody attacking and misery online, but it's actually played out exactly right. Most things in a business cycle terms, there tends to be things that lead and things that lag. So it looks like ETH led, at bottom first. The thing that lags is the further out the risk curve, which is NFTs. So NFTs are having a horrific time right now. You can blame it on Blur and other stuff, but really it's a factor of NFTs are recycling of capital within the space. So when people are making money, they want to buy premium NFTs, CryptoPunks or Fidenzas or whatever it may be. And when everybody's losing money, they don't do the same. It's the same with high-end real estate. It's the same with, Rolex watches. We saw that Rolex watch prices come down because of the same reason. Is once you go out, the kind of trophy assets and stuff, there's not enough money around. So that is still washing through the space. So that's I think the last part of what has to happen. And then as you say, the ETF is the chink of light on the other side. Now, the ETF in itself doesn't cause a stampede. If you launched the ETF between June and October, you would have had zero uptake. But the ETF, as price is rising, becomes very powerful. Because most people in this space are momentum investors, particularly the RIAs, the pension plans and others, the institutions have done the work on this space, and all they need is price because they don't want to look stupid. Everyone's investment committees beat them over the head saying, see, you were stupid thinking about this, but everybody I speak to, it's still on their plan. I mean, don't forget, BlackRock were talking about this during the last cycle. Remember they had Bitcoin on their website, and he was talking about, Fink was saying, we've had more hits on our website than we've ever had in history. They've been thinking about this through, as have most of the big players. So it feels that as the darkness is on NFTs, we see the light coming for new capital into the space, and then it flows through. And again, very typically in a cycle, you start with the benchmark asset, Bitcoin, that outperforms. Then as the capital comes into the space, because each other part of the space is less liquid, you put the same amount of money in. As it spreads down, it causes an outsized reaction in other parts of the space. So what the space does need is new capital, because we've been recycling capital for a while. It's the same with economies. There's no new investment anywhere going on in the global economy right now because of, except AI, because of the economic situation. Nobody's got money. But the moment people start making money again, it flows through, and we'll see again stuff like the ETH Bitcoin outperformance begin again. Now, interesting enough, I've been digging on work on that too, and I found that's entirely correlated to the business cycle. That I've got a certain set of indicators that kind of suggest when that happens, and it's based on liquidity, so it's the same thing. So that gets interesting to me as well. The business cycle is what drives liquidity, so we can use stuff like the ISM survey as where we are in the business cycle. If it's below 50, we tend to be in recessionary or contractionary times. If it's expanding and above, we tend to be expansionary times. But what we know is when the economy slows down, the answer to that is more liquidity, because that's how you stabilize the economy, whether it's cutting rates or whether it's increasing the Fed balance sheet. And I've spent a long time looking at this and developed something that I refer to as the everything code, and we can talk a bit about that later. But so there's a bunch of liquidity measures. They're not easy to do. Some of them you can get on TradingView, I think, because some people have built them. One is Fed net liquidity, which is US centric, which I don't think is the most important. And that is basically the Fed balance sheet minus the Treasury General account, which is the Treasury building or reducing liquidity, and the reverse repo. Those three things. And they actually have mirrored asset prices pretty well. But it's not all about the US, as we talked about before. So then you need a global proxy. So the global proxy that's easier for people to find is global money supply. But again, even that's difficult because there's no one measure of global money supply. So you have to kind of construct it yourself. But again, I think people have got that on TradingView now. How good it is or not, I don't know, because we use Bloomberg and Refinitiv and other data sources. And then finally, the big daddy of it all is we've got the Global Macro Investor, which is my research service, the weekly liquidity index. That's based around the G5 central bank balance sheet. So that's the US, the ECB, the PBOC in China, the Bank of Japan, and the Bank of England. That seems to explain 97% of the entire price movement of the NASDAQ and about 87.5% of Bitcoin. The reason why Bitcoin actually has a lower correlation than the NASDAQ is because of the up cycles, because the adoption rate is so high.
Because it goes up.
The blow off tops, right? That is the reason, because the compounding of that. But other than that, it's all driven by this factor, which is the central bank balance sheet is different to the general liquidity in the market, i.e. money supply and stuff like that. The central bank balance sheet is actually debasement of currency. So debasement of fiat currency is a thing that most people don't understand because it's not obvious. But when you are printing more of a currency, particularly when all the central banks are doing it, you're lowering the denominator, which is the same why the Venezuelan stock market looks like it goes vertical. It's because the Bolivar keeps going lower. So that is what is driving almost all asset prices. So once I started adjusting for that, I realized there was two assets that did better than anything else. Everything else, like equities divided by the Fed balance sheet, is a simple way of doing it, for people who can't find a larger set of thing. The S&P's gone nowhere since about 2012. since QE really became prevalent. This is the kind of moment in liquidity where things have bottomed because the central bank balance sheet stopped shrinking, and Japan started printing a bit. China started increasing money supply. The UK had to print quickly because it had a pension crisis, and then the Fed had to print quickly for the bank crisis. These were isolated events, but they're the markers that we know the more cowbell is coming. And then we're waiting for, okay, when do they really swing into action? Money printer go burr. You know, you can use the very simple bell curve meme of the money printer go burr. That's the one, that's the big signal. So really it's all about setting yourself up for that big signal, because crypto spring, which is where I think we got to from October, tends to be choppier, harder to trade. It's not an up-only market. It tends to make good progress, but it tends to be complicated because there's a lot of opposite narratives, which we're seeing, right? People don't trust this rally because of banning or because of this, because of that.